Good evening, everybody, and welcome to Financial Freedom Classroom. We accelerate your results. A little bit about us. We are John and Sherry Locke. We are owners of Locke in Your Success, and that company focuses on stock option trading, coaching, and education. We've also managed many successful businesses in a variety of industries, and we are active real estate investors, and also we provide loans and guidance to small businesses. And tonight, John's going to be talking about the bull, but first he's going to go over the disclaimer. But one other thing for housekeeping, if you do have any questions, please type them in the questions box and we will do our best to answer them during the presentation.
Okay, super. We have a special treat for you tonight. We have two disclaimers. We have a regular disclaimer and we have just the options disclaimer since we're going to be talking about trading. So just to quickly go through these, just to let you know, we're not licensed financial advisors, accountants, lawyers, or tax preparers, and therefore information in the presentation is no substitute for professional, legal, financial, accounting, or tax advice. Also, please be aware that different people have different objectives, and therefore the advice may or may not suit you, so make sure, again, you go out and seek professional advice. As far as the trading side of things, it's going to be for educational purposes only, and to let you know that we're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, any trades and or results covered in the presentation are hypothetical trades. And you should also be aware that there's a significant risk of loss in trading options, so please be aware of all your risks prior to placing any trades. Now that that's over with, before we get into trading at all, we want to just find out if you're actually ready to invest. So before anyone out there starts investing or taking risks with their capital, you need to make sure you have a certain amount of security ahead of time. So you want to make sure that you have your starter emergency fund fully funded. You want to make sure all your debts are paid off, and your full emergency fund of 8 months of expenses is also funded. After that, we're going to be looking at putting 15% of our annual income into retirement, and we can play with that money, especially if we're far from retirement, to see if we can get some better returns on it. And of course, any kind of extra money that you have from there on doesn't make a whole lot of sense to keep it in a 0% account. So it's you can be a little bit more aggressive with it and start doing a little bit better. So once you have that extra money, where can we invest our money? Obviously, we have our bank accounts and our CDs, which give us a very, very small amount of return, usually 0 to 2%. Normally doesn't even keep up with inflation. Very secure investment. You get to easy access to that money if it's in an account. Of course, the CDs, you don't get so much of an easy access to it. But the reality is you'd want to try and do better than that. If you want to do a little bit better than that and still be really safe, annuities are a decent option. Annuities, assuming you're dealing with an annuity that has an insurance company that has a stable financial worksheet, then a lot of times they'll guarantee principal. They'll give you rates of up to 6%, sometimes higher if you do a market-linked annuity. And again, that's very safe. Another thing that are considered to be safe is bonds. And bonds, they pretty much have the same risk as the stock market. They can go up, they can go down depending on what type of bonds you're in. But if you're in a good, high-quality bonds, sometimes you can average up to 6% on those on a year-over-year basis. And again, that's better than having a CD, right? So if you want to go up from there, the next step most people usually do is mutual funds. Now, mutual funds, you got to be careful with. There are funds out there that do return or have returned for a 10 to 20-year average, yearly return in the 12% range. They're kind of rare. And if they are returning that much, you want to make sure that they're not actually giving you any kind of high fees. Sometimes management fees can be high, and if you have a good return with a high management fee, it kind of kills the return. So you want to stay away from anything that has a lot of fees with it. But there are some funds out there, if you're careful in how you pick them, that do average that over a period of time. Of course, just like any higher return type of investment, there are risks involved, and you can end up taking some losses with that as well. So just keep that in mind. From there, if you're going to go into the stock market, I mean, of course, you have real estate and you have this other stuff, but we're going to be talking about the stock market tonight. If you're going to be going to a stock market, really your returns are almost literally unlimited. You can get some spectacular returns in the stock market. Unfortunately, there's only a select number of people who are actually profitable in the market long term. I mean, there are people that have good years, good runs of 3 to 5 years, but very long term, there's not that many. The vast majority of people that self-invest actually lose money over time, and there's really a good reason for that. That's because the people in the market that you're trading against when you're actually trading, all those mutual fund managers and high-frequency day traders, they have teams of people with virtually unlimited resources, and they're willing to work day and night for the sole purpose of making money in the market. And the money they're getting out of the market is usually your money. So they're very, very good at it, and like I said, that's their profession, so that's what they do. So you don't want to play their game. Unfortunately, there is actually a game that we can play and we can play it quite effectively, and we're going to talk about that today. But before we do, let's take a look at what most people do, and that is typically buying a stock. They'll do something like this. They'll go out and they'll get some education in the stock market and all the courses that are available out there on the internet, and they'll take some technical analysis courses and stuff like that, and they'll see a stock like this and they'll say, hey, IBM, this is a really nice stock. It's a really good company, good to invest in. If I look at do my technical analysis and I look at my charting, I can see that we're at a support level, and boy, the market's going to go up to probably $195 here from 180. That's a really good. That's going to be a really good return for me. So they'll come in and they'll buy something like that, and next thing you know, something like this happens. Right? They have an earnings announcement or some sort of an event, then boom, they lose all this money, and then they'll be like, well, I've been watching TV or on the internet, and you know what they say, you get a good company, they get bad news, it's a good time to buy. I don't want to sell out now. So they hold on to the stock. And something like this happens. And then they start to get a little freaked out, and they get like, oh wow, this is really bad. I lost, I bought this at $180 or $182, and now it's $150. I lost all this money. I think I'm going to dump it. And next thing you know, that happens. And and then they're like, oh no, I was right. I should have held on to the stock. So they buy it back, and then that happens. Oh, right. Sorry. So, and that's kind of the mentality. And by this point, they get really, really frustrated, and they just kind of give up, and then they go and they try some other trading system, or they try another stock, and they kind of do the same thing over again, over and over and over. And that's the typical path of a directional trader. Just to step back a little bit, I want to just take a look at the analyze graph, because I know some people here don't probably have any idea what I'm talking about. This is called an analyze graph, and what you have across the bottom is the price of an asset or a stock or an index or whatever this happens to be, and up the left side is going to be the profit and loss, or how much money you make or lose with the price of the stock. So here, if we buy this stock at around $1,129, if it goes up, then if you say to around $1,179, then I make around $4,800. If it goes down to $1,169, I lose close to $5,000. So it's basically a one-to-one. We have a 50-50 shot of making money. The price goes up, I make money. The price goes down, I lose money. Now, what a lot of people do is they start buying and selling stocks, and they find that they have trouble making money. They eventually buy more courses because they're not making anything, and eventually they come across this guy or this program that sells options, and they say, hey, options are better than stocks. You can limit your risk of losses, and you can leverage yourself so that you can make more money. So they go out and they start buying options, and instead of losing a little money on stocks, they leverage themselves and they lose a lot of money on options. This is because if you look at buying an option, and we look at this graph here, if I were to buy this option, the solid line represents the actual value of the option at expiration, because option is what an option is an option to buy a stock or an asset at a certain price. And in order to have that option, you actually have to pay a time premium. So this dotted line actually represents the value of that option today. The solid line represents the value of that option when that option expires. And what happens is this dotted line comes down towards the solid line as time goes by. And basically what that means is not only now do you have to be right in direction if you buy an option hoping the market's going to go up, you also have to be right in timing, because the market can go up a reasonable amount of money depending on which option you buy. In other words, you can be right on direction and you can still lose money. So now you're taking a situation where you had a 50-50 shot of making money, and now you have even less of a chance of making money. And that can be a problem. Plus, people tend to actually invest more money than they should in these options because, like I said, a lot of times you can lose the whole value of an option a lot faster than you can lose the whole value of a stock.
Can you explain the leverage part of that a little bit?
Yeah. If I was going to buy a stock at, and this would be a very high-priced stock, right? But if I was going to buy one share of this, it would cost me, let's see, the value looks like it's around $1,130. If I bought one share of this, it would cost me $1,130. If I bought 100 shares of it, it would cost me $110,000 plus, around $110,000. If we translate that to one, I could buy one of these options for $7,000, or I could buy 100 shares of stock for $110,000. Okay, so one option for $7,000, controlling 100 shares, right? One option for $7,000 that controls 100 shares, or buy 100 shares for $110,000. So
I like the option deal better.
Right, the option deal's better, right? I can control that stock for that much money, and then if the price goes up, then I get to make the same amount of money if the price goes up enough. So with $7,000, I can make a lot more money than I could with $110,000 or whatever. So
that's a deal.
So that's really heavily leveraged. Except the only issue with that is my chances of making money are a lot less. So depending on how you manage your money, I mean, there's definitely a lot of money in trading this way if you're effective at it, and leveraging does work. Leveraging is really cool, but the thing is, a lot of people don't do that right, and they end up taking losses in the markets. So
we don't want to do that.
No, we generally don't want to do that. So if we go to the next thing, right, our next option, the next course most people they go, well, if I don't buy the option, I can sell the option. So I can take the same option here, and I can sell those options instead of buying them. Now, I still want the price to go up, but as time goes by, this dotted line is going to go towards the solid line, and as long as the price doesn't go below a certain amount, I'm actually going to make money here. So I can make money if the market goes up. I can make money if the market stays here. I can even make money if the market goes down against me. Much higher probability of making money. Now, if I just sell this put option, there's an awful lot of risk here. Here is they're margining me $167,000 to sell these options here, because I essentially have unlimited risk to the downside. So that being the case, a lot of times what we're going to do is we're going to do what we call complex option spreads, and we're going to come in here and do verticals. This is where I sell that option, but then I limit my risk by buying another option. So I still have the same type of graph here. I still have I get to make a little less money because I have to pay to cover myself. So I get to make a little bit less money, but essentially, as long as the stock stays over this limit, and if I let it expire, theoretically, I can make money. If the price goes up, I can make money. If it stays, I can make money. So same concept here, except I have less risk now. So at this point, I'm risking $25,000 to make around $5,000 in the market, and it's a high probability trade, which is really cool. Now, there's a lot of different types of spreads we can put on. We can put on, this one here is something that's called a bull vertical, and it's going to make money theoretically as long as the market stays over, what do we have, about 1070 here. Then we have other spreads like a bear vertical spread. This is something if you wanted the market, if you were thinking the market was going to go down or the asset was going to go down, you can put on a bear vertical spread, and as long as the market doesn't go over 1188, you make whatever this is here around $3,500 or so. So same type of concept. And then we have our more complex spreads, which is we have a bull vertical spread with a bear vertical spread. They call this a butterfly. And something like this is you get a very, very good risk-reward ratio, but you have a much lower chance of making money from a probability standpoint because you really need to be between 1168 and 1188 in order to make money, but you'd make money in this range. And then, of course, we have our condors, which are those two vertical spreads that are spread out. We have, in the same thing, you make money between these two ends. We have what they call calendar spreads, where you buy an option in one month and sell an option in another month and create a butterfly-looking type of a trade. And, of course, we have our diagonals, which are essentially the same thing as it's the calendar equivalent to a vertical spread, and we have our calendar equivalent to a condor, which is a double diagonal. So all those things are complex option spreads, and they're really cool. So there are many ways to do these higher probability complex option spreads, and one of the biggest things here we have people who get into these, and you know what their success rate is? It's pretty much the same success rate as somebody who comes in and actually does directional stocks. The reality of your probabilities in doing a lot of these trades aren't a whole lot better than buying stocks, even though they're positive theta trades, because realistically the market has to stay in a certain price range, and if it doesn't stay in that range, then you end up having to adjust these trades and so forth. And adjusting these trades can be more complicated than you think it is. So that being the case, these can be quite challenging as well. So what is a new person going to do, right, to make money in the market over a standard period of time? And one of the things that we put together is a trade called the bull. And it goes with a simple concept that if you look at the stock market and you start looking at charts, one of the things you'll notice is that most of the time, and I emphasize the word time, the market is going up. That's the reason that we can buy mutual funds and they make money. That's the reason why people can buy stocks in general, long-term investors, and make money, because the market is generally going up. So it's generally headed in an upward direction. So the premise is that you should be in a bullish trade if you're generally playing the market and you're not really paying attention to technical analysis, is probably better off. The next thing we're looking at is we're looking at these time spreads, or the vertical spreads, that are high probability trades. So we have a market that generally goes up, so we would like to be bullish. We don't want a 50-50 shot that the market might go up, the market might go down. So what can we do? What we can do is we can do a high probability trade. Realistically, what's the highest probability trade that you can do? It's not an iron condor. It's not a double diagonal. It is a bullish vertical. Or the other type of high probability trade would be a diagonal that can't lose to the upside. So these would be the two higher probability, the highest one being actually being a bull vertical, again because the market's generally going up, and because we're selling an option that's out of the money. So as soon as you take this and you make it into a condor, you've basically cut your probabilities in half. So this would be the highest probability setup that you could have. So a bull verticals do make sense. Now this trade I put together is a beginner's trade, and the good part is that it's going to beat the general S&P 500. It's going to beat pretty much any mutual fund that you'll see most of the time, and it's very, very effective. And this is how simple it is. There's no technical analysis. There's no searching for stocks. There's no adjustments. It's something we check once a day. It's 2 trades per month and has a 73% win rate. And this is what the guidelines for something like that look like. So, if you're new to investing and you want something that's really, really effective, then something that's going to beat most mutual funds, then you can open up a brokerage account. You can kind of go into something like this. So the guidelines are quite simple. We just enter 65 days to expiration. And again, this can be done on a lot of different things. I would suggest that you do it on an index. I would not do something like this on stocks because stocks can drop too far too fast. But an index in general is going to be much more stable than a stock. It's not going to drop in half overnight, for example, where you might get that out of a stock or something like that. So if you take some sort of an index or an ETF that mirrors an index, you go 65 days to expiration and you exit the trade 37 days to expiration or 30 days to expiration, or in other words, when next month comes due. So I'm going to enter the 65 days to expiration in January, for example. When February becomes 65 days to expiration, I'm going to exit January. I'm going to go into February. That might be 7 or 30 days to expiration for the January trade. If I do a one lot or one vertical, I have a maximum loss of $250. I'll have a maximum gain of $250, and I'll show you a picture of it. I'll have approximate planned capital, or this is going to actually cost me $2,750 in order to see if I'm going to make that money or not. And all I'm going to do is I'm going to sell a 30-point wide bull vertical put spread. And the short strike is going to be the strike that's closest to 10 delta. Or I try to get $2.50 credit. Generally, you can do that with a 10 delta call. If I have to choose between an 11 and a 9, I'll do whatever is going to give me $250 or more. And I'm just going to buy a long strike 30 points lower. And there are no adjustments to this. The only thing you're going to do is if you hit your maximum loss of $250, then we're going to exit the trade. And we're just going to sit out of the market until it's time for the next month. And we're going to go back in 65 days to expiration and go ahead and do the same thing over again. Very, very simple position. It's going to look something like this. This is a example on the Russell. If you don't know, it's a price matrix. It shows us all our options. This shows us October options that are 65 days to expiration. It shows us coming in here selling a 970 delta put and buying 30 points lower, and it's going to give us a credit here of actually about $2,500. So if we come in here, you can see our credit's right about $2,500, and essentially, as long as the market doesn't drop to where I'm going to lose $2,500, right? This is a 10 lot, so it's 10 times the size we're talking. As long as the market doesn't drop to the point where I get $2,500 down, which is here, is going to be at about a 1070. As long as the market stays over 1070, then I'm not going to have to exit the trade in the time period that I'm going to be trading. If the market, wherever the market is when the next month is 65 days to expiration, I'm going to exit this. I might be down a little money, I might be up a little money, I don't know, but I'm just going to simply be disciplined and I'm going to exit it. Whether, like I said, whether it's up or down. And of course, if I hit my maximum loss, then I just exit it and I wait till the next month. So it's as simple as that. If that's all you do, and you do nothing else, this is what our historical results are in this trade. Now, with a lot of these trades, people are going to say, well, you got this execution thing, you got to time all these adjustment rights, you have to do this, you have to do that. There is none of that with this. You can take this and you can back trade this in an afternoon, right? And you can go back to 2002 and you can go ahead and do this every single month, month after month, simply putting on the trade, exiting the trade if you lose. If you did that from 2002 to 2014, you would average 9 wins and 3 losses. You would have won every year except for 2002 and 2008. In this period, the S&P 500, if you just take a simple average and average all the years, add them up and divide them, you're going to have a 6.5% return from the S&P 500. Something like this, you're going to have a 23.2% return. The mutual funds use the S&P 500 as a benchmark, and very, very few of them beat that. Directional traders, very, very few of them beat that. And most other types of traders, very, very few of them beat that number. These guys who do condor trades and all that other stuff, they might beat these numbers in individual years, but very, very few of them are going to beat that over a period from 2002 to 2014. So you can literally come in and do something really, really simple like this and outperform 95% of the traders in the world and almost any mutual fund. So that's pretty cool, and you really don't even need to know what an option is. You can just come in and do this. You just have to know how to use your broker, and you have to keep track of stuff, and most importantly, you have to be disciplined. But this here is, like I said, it's a very, very effective strategy. Now, and I urge you to test it. So you go in, you can buy some software like from OptionView. If you don't know what this is, then call me or email me, and I'll talk to you about it, show you how to use it. But there's a software called OptionView where you can go back and you can do historical tests on stuff. You can try this. You can back trade it in an afternoon. Very, very, very simple. One of the things I'm often asked is, can it be done as a bear vertical? Hey, what if instead of doing a bull vertical every month, I do a bear vertical? Bear verticals do not work. Bear verticals are, unless, with the exception of a couple of years, and those couple of years are 2002 and 2008, and even in 2008, bear verticals didn't make that much money. They got blown out to the upside a lot. This is a trade in general that, like I said, loses a lot. Not only do you get, because if you were to sell a 10 delta put spread and a 10 delta spread, you'd get a lot more money for selling the put spread, right? So that's one reason. Therefore, that's one reason that the call spread is going to lose faster than the put spread. Also, if the market goes up a whole lot more than it goes down, a whole lot more often, and almost as much. So that being the case, a lot of this trade just loses a lot. So it looks high probability, but it's not. So the next thing I go, well, why don't I do a condor and make more money? It's the same thing with a condor. Now, because when you do a condor, most of the time the bull spread is going to win. You're going to have problems with the upper side. And most of the time, this bull spread is just making up losses for the call spread, and that doesn't make up for the amount of times that the call spread loses. So doing the straight bullish vertical actually is a lot easier. It's a lot easier to manage. It's actually a whole lot higher probability, and it just does really, really well. So that is one of the ways that you can come in if you want to manage your own money and go ahead and do that. Now, another question I'm always asked too is, what if the price comes down too much? How do I protect the position? The reality is yes, there's a lot of ways that you can do price protection when a vertical comes down. However, I can say that most traders, 95% of the traders I talk to, whenever they try to adjust a vertical, it may help sometimes, it may correct the position sometimes, but 99% of the time, the traders are just making the situation worse. They're either increasing downside risk and hoping the market reverses, which is bad, or they're taking on larger, or they come in and they do something like sell the call side of the vertical, and they start taking on this large amounts of upside risk, and they start taking losses on the reversals. So over time, most traders, unless you're very skilled, if you're like into one of my M3 programs or something like that, then you probably know what to do, and you could protect the downside without getting killed on the upside. But for the most part, it's in game. They're off just to leave it. So that is the bull, and like I said, that's a very, very effective place to put at least some of your money, because you have a fairly high return with that. So, and I could also mention, right, so I got a note here that I could also mention that if you're trading something like index options, then you do get, always ask your accountant to verify this, but you do get favorable tax treatment. where they tax you a little bit differently rather than regular income. So that's always a very good thing too. You get very good tax treatment. And I don't know if there are any other questions with this particular strategy. So it's very, very simple. And if you're interested in doing something with your money and you do not want to give it to a mutual fund advisor and you want to do something more aggressive than keeping it in the bank, then it's a good idea, like I said, to at least take a little bit of your money, do something like this. When you think about it, if you take your money and you give it to a mutual fund advisor, and for some reason people don't mind if they put money in mutual funds and it's up, they make money 3 or 4 months, they lose money 3 or 4 months, they make money a couple of months, they lose money a couple of months. If it's with a mutual fund advisor, hey, no problem, nobody even thinks about it. But a lot of times if you're managing it yourself, you freak out and you try not to lose any money on any individual month. Then that's what kills you with your long-term returns. You're better off just to kind of treat it like a mutual fund, put the position on, take the position off. If the market goes into this bearish trend, at least you have the power where you can be out of the market and sit on the sidelines for a while. Very easy to pull your money out and just kind of wait it out if the market's doing something crazy. But whereas if you have it with a mutual fund, sometimes it takes time to get out of the market and things like that. So I really like that type of position. It's pretty cool. And if there are no questions, that's what I have tonight. I hope you've enjoyed the presentation.
Question or comment?
Yeah. So what if I hate to be a contrarian, but what if we enter a 2 or 3 bearish cycle with the market being oversold? You may end up taking a loss that particular month. That's why we lose 3 and gain 9 in any given year. So if we were doing this strategy over since 2002, every single month, if you look at the records, we lost some months, we made some months. If you are doing this strategy, one of the things that I do, and one of the things we'll be coming out with soon in super simple spreads trades, the next program we're doing with SMB is going to be that. It's going to include the bull, but it's also going to include the bull with a bearish butterfly combination trade. So if you end up in that situation where you're somebody who watches the market and is fairly good with technical analysis, and the market's been up a lot, then we can enter this trade on top of a bearish butterfly trade, or we can enter this trade some other way. But in general, if you're the guy who's not paying any attention to the market whatsoever, and you're just doing in there, and you're, as an alternative to being in mutual funds, you can go into something like this. What I can tell you is most years, with the exception of very few years, if you're in some of these, we don't want to say give any names, but if you're in some of these programs that do, income trades, any given year, you'll probably beat almost everybody in your group just doing that. So it's a pretty little thing. It's pretty easy. Yeah, you can start using market filters and stuff. Like I said, there's a lot of stuff that you can do with this. Most of it, you'll probably get worse results, but there's a lot of stuff that you can do.
We don't want worse. We certainly want better. So.
Oh, I realize that. And this is a strategy that I've been showing people for years, and nobody does it.
Oh, maybe because it's too simple?
It's too simple, and they get in their head, I can't lose, I can't lose, I can't lose. But the reality is you're much better off just to let it loose. Yeah. And if you let it lose, it's fine. I've been doing this for years. And
follow the rules.
Just follow the rules. And I know technical analysis. I just follow the rules. It does fine. I mean, like I said, the proof is in the past results. And yes, you have times when you go in the market and you cringe because I go in, I put this trade on, and I'm cringing because the market's so high. And you know what? It usually works out.
There you go.
Sometimes it doesn't.
Trust the process.
But the thing is, if it doesn't work out, the next month you're usually that much better off. So if you look at it as a long-term rolling trade, then that should be great. Could I show the option view link again? Yeah, let me show the option view link. There we go.
Actually, that's just an email, right?
Yes, yes, well, this is an email, but it's optionview.com. James Hogan is the contact that I have. If you're interested in getting OptionView and you don't have it, then you can ask him for an extended free trial. They'll usually tell him you're with John Locke, and they'll and ask for the extended free trial. He'll give it to you. All right. Well, I think that's it. I hope you enjoyed that. It's a lot of fun. Bye, everybody.
Bye-bye.